Boom! We are back. We're in the studio. I could cry tears of happiness. It's been about 2 months. I'm sitting next to my co-founder. My name is Andrew Kuhn. We're back. How's everybody doing? Geoff, how's it going? Is this the best day of your life too?
It's going well, Andrew. How's
it
it
is going great. I'm so happy. I'm so over streaming online, even though I'm sure we're going to do it in the future. But I'm happy to be back. Hope everyone else is having a great day. If this is the first time you're tuning in with us on YouTube, hit that subscribe button. I just feel like out of place right now. I feel like my back's not, like we were just doing something about 5 minutes ago, recording with somebody else. And I felt like my back was starting to get a little weak because I haven't had to sit up and stabilize because our chairs don't have back things,
Uh-huh.
We haven't done this in a while. I'm so happy to be back. If you're watching us on YouTube, hit that subscribe button. If you're listening to us on the podcast, a rating and review goes a very long way. We're bringing you guys a ton of content, having a lot of fun doing it. Make sure you check out my Twitter @Focus Compound. So the best day of the year happened last weekend. It was Warren Buffett's Berkshire meeting. And he was out there all by himself with Mr. Greg, no Mr. Munger this year. And it was one that I thought was definitely a very interesting meeting. They kept showing the auditorium, and it was just to add perspective that it's literally just him. And kudos to him, by the way, too, for not canceling it. They probably could have done it somewhere else, but I'm sure he put down the deposit and didn't want to stiff them, especially because he said, Omaha was going through a tough time. He plugged the bookworm and stuff like that. But I thought it was a very good meeting, and there was a lot of takeaways that I had. So I figured we could just talk about it, and we'll do our Q&A probably on Wednesday throughout the week. So if you want to be on the lookout for that, follow me on Twitter @Focus Compound. Man, I hope this quality just sounds so good coming through. I'm just so happy to be back.
Better now.
I know, right? A few things that really stood out that a lot of people were talking about. Airlines, for example, they sold Airlines.
Right.
They haven't made any major purchases or any purchases during.
Not by him.
Yeah,
he said he didn't know what they were, so they were probably Ted or Todd.
Yeah, and they didn't buy back any of their stock. So they're sitting on a lot of cash. Biggest takeaway from me from that was, wow, Buffett probably isn't as bullish. He gave this hour-long monologue, just on his thoughts, and he was talking about the depression a lot. And you were actually just talking about it before, how when he was born, they didn't know that they were in a depression at the time.
He made a point of that, that the market had already covered 20% after the crash in 29, and then it went on to go, down 83% from that point?
Yeah.
From when he was born,
So it was just a very good, I thought it was one of the better meetings that they've had in a long time because there wasn't a lot of shareholder questions on, personal stuff. It was strictly investing. And of course the personal stuff is important and I always think very interesting. Sort of following this Buffett and Munger way, I don't think it's just like a way for investing. It's also just an appropriate way to take certain qualities and put them in your own life. But it was just, given the unprecedented times that we're having right now, I thought it was great that it was pretty much all investing focused.
Yep.
That was one of the big things that stuck out to me was the Airlines. He's a very, in his humility, right? We were talking about that before, how he just said, we made a mistake. And once they realized that they made a mistake, they were so quick to dump the position.
Yeah.
Did you have any thoughts on that?
Yeah. I thought that was a great way. I actually wrote down a note about it. I thought that was a great way of handling a mistake. Because a lot of people, once they own a stock like that or something, then they try to figure out, is it still a good stock for me to own? And on a totally different thesis or whatever you want to say than what they originally bought into it. He obviously thought that he saw a future of tighter supply than there had been in the past, more rational supply of airline seats into the next few years at least, because you could look into how many planes they were ordering and look in demand. And this disrupted that. So now he doesn't see that. And so it's not just about that they're going to need a lot of money now. It's that the industry may change in that it will be oversupplied, which he wasn't counting on. And that's why he didn't like the airline industry originally, because it used to get oversupplied all the time with planes. And now it has that potential again with low load factors, which you mentioned. So it just completely changes his perspective on it because he knew what the supply situation was going to be. And still does, but he didn't expect that demand might drop. I mean, that was not something that people expected, that demand could decline and stay down for a few years. He said, we don't know. It could be that it takes 2 or 3 years that we're not back at the levels that we are now. And if that's true, you're getting deliveries to new planes and things. So that means your load factors are low, and it means it's totally different than the investment he thought he was making.
I thought it was interesting because we've spoken a lot about AirCap Holdings and airlines and airports on the podcast recently. And one of the things that you have been continuously hammering is you think that, there's just going to be a massive supply of airplanes, right? And what do you do with them? Like you were just joking about on the last podcast, when it comes to airports and maybe Boeing, for example, they have terrible barriers to exit, right? What do you do with it when, tough times come? So I thought that was interesting to hear him sort of echo that. For one part, I was like, wow, he's saying a lot of what Geoff's been saying for the past couple of weeks.
Yeah. I don't like being this negative on something. And no,
you've been doing a good job being negative lately. It's good. I said I'm changing you. I'm ruining you is what I said, actually.
And it's heartless on the perspective of like the things that will shut down and stuff. But the thing is, the reason why restaurants potentially can recover faster is because it's not very hard for especially the smaller ones to exit the industry. It's really easy to close down restaurant locations. It happens all the time. Even something like supermarkets or something, a fair number of them, you could easily have one. I mean, supermarkets are another thing being hit right now, but you could easily have 1 out of 25 that leave the industry each year or something. And that leaves the better performing ones to pick up better returns. A lot of people focus on like the growth in an industry or something, but it's the growth in your business versus making sure that competitors aren't growing, that fast that to take up all the growth that you'd have in the industry. And so it is a big issue in some industries where you don't have where there are barriers to exit. I mean, people always talk about with moats barriers to entry, but they don't talk about how bad an industry can be when there's barriers to exit. And I just don't see. I mean, these airlines are all going to be propped up by governments or by someone, and I don't see that they're going to say, and people are going to want there to be new planes built and stuff, just even from an economic perspective, because he talked about how important Boeing and Airbus and stuff are to their economies. So everyone's not going to want a big contraction of supply in planes. But what's going to be needed for the industry to earn good returns is a big contraction in the supply of planes.
Yeah, sure. What did you think about them not repurchasing any shares? Was that surprising to you?
It wasn't surprising to me. I mean, they could have done it.
There's a lot of individuals that have been involved in the stock saying, I'm sure Mr. Buffett is rebuying, purchasing back stock. They said, I'm sure their phone is ringing off the hook, and I'm sure they're purchasing back their own stock. They have $100-something billion that they're going to put to use. Wow. And it's just like boom, 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 nothing.
It doesn't surprise me because Buffett doesn't tend to do things on a small scale. He wants to do, when he buys back stock or whatever, he may buy back a little, but his hope is to buy back a lot more, I think. And to do deals is to do a lot bigger deals. The airline thing, he bought all the airlines in the industry, So I don't think that he would ever try to signal to people, the confidence or, okay, we could buy a little bit of our stock because it's not really overpriced, even though I don't think it's more underpriced than it was before. He just doesn't care about those things, So he doesn't do half measures and things. I mean, he said that. So I think that I was expecting there to be very little activity in buying stocks and very little activity in buying back stocks. Although I was also expecting there to be very little activity in selling stocks. And I think what we've found out is basically they just sold airlines. Like, I didn't expect them to be dumping other stocks because they were suddenly worried about, those things. His default mode is inaction. And then only take action when you're sure about what you're going to do. But when you're not sure, just don't do anything.
Which is probably a good lesson for a lot of people, right?
Yeah, I think so. He talked a lot about the problems that people have even just staying in an index fund or something, because he said several times that the virus, just like the virus affects people differently, fear affects people differently. And one of the interesting things he said is he didn't think that he or Charlie Munger ever felt fear financially. And most people probably do quite a lot. And so that might lead them to make bad decisions and things. And so he did warn about that when he said, well,
it's easy to do when you also have $80 billion and but 99% of even that 1% that's not invested in Berkshire is still a pretty significant chunk of change.
He put 75% I think of his net worth into Geico when he was he would have been in his very, very early 20s. And everyone he talked to in the insurance industry said, don't do it. Graham thought the stock market was high, as he mentioned then. And Graham would never put that much money into one thing. And he had trouble selling Geico to people when he worked as a broker. So I don't think that he does feel fear financially. I think that's true. And some people do. And
do you think that's a gene thing? What do you think that is?
Yes.
So like what, just being rational about it? Having that in your... let me preface it. You and I have spoken before about this. And you have said, if you own a stock and let's say you appraise it, just for simple math, let's say you appraise it at $100 and let's say it drops from, $60 to $40. You have literally told me it doesn't bother you in the slightest. As long as you know the facts are still the same and nothing material has changed within the business. And everyone says this, right? Everyone says this until it actually happens. And then there's a lot of fear that comes into it because capital is involved. It's almost like a psychological thing. Some people, they start to be like, it's almost like it takes them back to the childhood. Like, oh, this person told me I would never be that. It pulls out all these weird thoughts in a lot of individuals. And I've spoken, but for you have told me, you're like, it literally it doesn't even, you don't even think about it.
On this point, I think my internal feelings are exactly the same as Munger and Buffett. And for whatever reason. And a lot of other people aren't. And I've tried to talk to other people and explain things to them, sometimes knowing that they won't carry out the plan that we agree on.
So what do you mean by that?
Like literally sit down and say, okay, they'll say, look, I have, we talk about like how much I like the book A Man for All Markets. They'll basically say to me, I have an edge in this thing. I know that, look, I have information, not inside information or something, but I have information that the market is not correctly handling this arbitrage type thing or this litigation thing. Let's use litigation example. Like they know there's a 95% chance this appeal will be upheld and the market's clearly valuing at 50-50. And they could know that with all their heart and they could be an expert on it. And when we talk about how much they should bet on it and everything, they will bet less than they should. And as the market moves down, even though I'll say, it's a random walk. You shouldn't be. You should be assuming that most price movements are just noise and stuff. They will sell somewhat. They'll trim, and then as the price recovers and starts to go back up, then they'll put back on the position. Yeah.
When they get like the confirmation.
Yeah.
I think from watching markets over the years, and I don't have any studies on this, but I think markets just randomly move around like 80% of the time, 85% of the time, and then really the other percent is when they're actually moving based on. News or something that's actionable. Do you think it's the liquidity that makes people think like that? I mean, if you think about people that, for example, invest in real estate and they're not getting daily statements or minute by minute statements or whatever, that their temperament towards it could be different than the way that those individuals could handle stocks.
Yeah. I think stocks are a particularly difficult form of investment for people who feel fear financially and who are susceptible to contagion, hysteria, whatever you want to call it. I mean, that's sort of the technical term for it. Hysteria of picking up emotions off of other people and stuff, of their fear, their greed, whatever. I mean, when you talk about people like Munger or Buffett or when we talk about me or something, one thing is the attitudes and moods of people around me and stuff is not something that I pick up and that changes my mood a lot. And there are a lot of people who are much more, whether it's that they're more extroverted people or whatever, more empathetic people, they definitely are more susceptible to having their moods changed by the moods that they're feeling in a group in all sorts of ways, and not just having to do with financial stuff. But it's particularly tough for stocks because of the movements that you see with it. I mean, one thing, a lot of people would benefit from owning a bond that doesn't get a quote on it. Yeah. Because they know what it'll eventually mature at, and they know what their interest is that they'll collect on it. And having a quote will be a bad thing. I mean, actually, back in like the 1920s and stuff, there were some people who suggested that, saying, financial advisors and stuff, saying we should put people into things that there isn't an active market for, because when there became pretty active markets in some bonds, they were concerned about that with people, and that's something where we're talking about quotes every few days or something back then, for those sorts of securities. Now we're talking about something where you can get a quote every minute and react to it. You could say, okay, you say you own airline stocks. You could say, oh, I wonder what will happen to the airlines when Buffett, because Buffett said this. So let me check the futures and let me be there when it opens. And,
Yeah. One thing I thought was interesting is, so his lack of purchases, he has Bill Gates' ear. So he's probably sourcing a lot of his information from somebody that is spending billions of dollars to fight this, is probably one of the most in the know individuals that's in Buffett's circle to the pandemic. And the vast majority of companies that he owns, right? Both through companies that they own, and Greg was saying that one of the businesses they own owns 90 other businesses.
Yeah,
I mean, so think
Marmon,
about the vast majority of information, sales reports, et cetera, that he's able to draw from day by day. So I just thought that was a pretty interesting, I don't want to say it's like a tell, but you could see where his, I guess, lack of bullishness could be. And I don't want to say lack of bullishness, but I don't want to say flat out bearishness, but it's definitely lack of bullishness is what I would say, at least in the near term. But it seems like it's really we don't know right now. So that's why he's just kind of doing nothing.
Yeah. He doesn't know the outcome. And he's said that several times. He said that about a lot of things. Even when he talked about the Fed, he said the Fed doesn't know. I don't know whether there'll be, basically easy access to credit and stuff in 3 months, 6 months, 9 months. There is now. That's what we know. But no one knows that, and no one can know that. And he even said, the Fed can't know that. And, that's true. So I think he's prepared for a lot of different things. That's what he talked about. He talked about the option and value of money. And he also wants to probably make sure that he's running things a little more conservatively in terms of Berkshire's balance sheet and stuff.
Well, it's nice to see that they didn't. If I was a Berkshire shareholder, I would want to know if they had some sort of tail risk from pandemics.
Yeah, I thought that was very unlikely just because of the way. Yeah. I mean, the media stuff reports on it almost like.
He said the time to write pandemic risk is after a pandemic ends.
Yeah, that's definitely true. Yeah. But like things like business interruption stuff, I know people want to have that covered, but that's specific. I mean, that's very clearly not covered. He said there is one insurer, I don't know which insurer he was referring to, that had written business in a way that was not the standard language, and so could be exposed to business interruption stuff. But no, I never thought that the insurance industry would be majorly affected by the virus directly, I guess is the thing. However, what he did say, which is absolutely true, is there'll be a ton of litigation, whether it has much merit or not. And that'll be true for all sorts of things. And he also mentioned like non-payment and stuff, which is a big deal for auto insurers, that there'll be more people not paying and that they're basically covering people who aren't paying. And, we'll see what happens there. But he mentioned that uninsured drivers are a lot riskier, but that may not be true if these people had usually been paying and now they're just uninsured. So it'll be a little harder to calculate some risks.
Did you think it was funny when he put up his slides? A lot of people were having a lot of fun with that because it's just like, well, he just destroyed McKinsey's business model with all the fancy slides and stuff. And I thought it was also funny when he put up like a YouTube video that has like 800 views.
Yes.
And telling me, I was like, yes, there's hope for us to have only 800 views on YouTube. But he spent a long time talking about just like, being, don't bet against America.
Yes.
But what's interesting is, so he had that slide, don't bet against America, but the slide before that, I felt like the layout wasn't as good because the slide before that was showing that he didn't purchase anything new. I was like, oh, that's kind of interesting layout. You know what I'm saying?
Right.
But I think he was really showing, okay, look, over the next 20, 30, 40 years, things tend to work out in this country. The best country in the world.
Yeah, I think the thing he wasn't saying, because one thing that really stood out to me was he said, I'm going to show you what we did in April. Because I think he's basically was saying, I feel obligated to show you this because I'm telling you all these things about Buy America.
Yeah.
But not Buy America. That was in 2008. It said that. But don't bet against America in the long run.
It was a nice political slogan.
But that I actually wasn't doing anything now. And I think what he reiterated like several times is anything can happen in the short term, and it can be very bad, and it can seem very bad, and it can change people's psyches. He used that term a lot. And one thing he said that was really interesting was he said, after the summer and stuff, if this comes back, I don't know how the public will react to this. Yeah. And he talked a lot about the psyche of the public and like how he also said that this might be causing some people to understandably kind of lose their bearings and stuff and things like that. And it's something that I wonder about because when you think about like, for instance, retailers now have to be planning for Christmas. So what do they do about that? Do they feel as optimistic about it as before? Do they feel that they are sure that they'll have a Christmas season that's normal for them. Now, Amazon may feel that they will, but most sales aren't Amazon. Or do they kind of hedge their bets or whatever? They can try to get insurance for different things, but it's unlikely that they'll get it at a reasonable rate. So what do? Because he said things like, look, we're never going to sell our Easter candy at C's. Yeah. I mean, we've got chocolate bunnies and stuff, but they're not good for years. So, and that's true for some businesses. There's stuff that's just, they have the inventory for it and stuff, and it's just not going to be sold. And there's going to be a bunch of liquidation of inventory in certain industries. I mean, it's not stuff that's super obvious, like candy goes bad and it's seasonal and stuff. But fashion things and stuff, it's what they plan for spring. They can't just sell in fall and stuff.
Mm-hmm. Yeah, no, it's really interesting. So, what was your biggest takeaway from the meeting?
My biggest takeaway from the meeting was that he sees a really wide range of possibilities. He sees the thing that he's most concerned about would be the sort of knock-on effects or whatever of the group psychology or whatever, of how people will react to these things if they happen again intermittently or whatever. Not that he has this wide range of fears about how many people will die from the virus and things like that, but what happens if you have to shut things down again at some point? How do people react? How do businesses react? And the thing that he really brought up a lot was how the Great Depression warped people's minds, so that one of the smartest people that he knows, Ben Graham, said the market was expensive in the early 1950s, when really it wasn't that expensive, but that people just believed that if the market got back to where it was 25 years earlier, that was something crazy. And so I think, in a sense, he was warning the psychology of people can swing so much more than is justified. And that might mean people are too optimistic now. And he might be preparing them for the possibility that there'll be a time when everyone around you is too pessimistic. But keep betting in the long run on America and stuff. So I think he was saying, people's emotions swing one way or the other for long periods of times. That doesn't have much bearing on actually what's happening in the long run in stocks.
I wonder if we'll see some big deals come through soon.
I am very
he said we'd like to do a $30-40 billion deal if they get the opportunity, Yeah,
absolutely. But it's incredibly easy to borrow money. And it's been surprisingly easy to issue
with the government
equity.
too, right? A lot of people probably didn't go to Berkshire because the government was effectively helping out businesses and stuff.
And the perception was that they would be there and stuff. But even things like, Boeing was able to, raise an incredible amount of money and from the private sector. So that's really surprising. We talked a little bit about Carnival and stuff. Carnival was able to raise a lot of money in some bonds that, that's the stuff that's really impressive. When they're able to issue a bunch of stock at low prices, that's a little more understandable because there's potentially a very big upside. There could be a downside that's zero, but it's much harder to evaluate those, and you could be getting a really good deal. On the other hand, it's the bond stuff, the ability to access credit that way, and also just even borrowing from banks and stuff, that is the really surprising thing because, Netflix stock, is it expensive? Is it not? I don't know. But, or Tesla, I don't know. But if you lend them money, you just get your principal back plus the interest in the best case scenario.
Sure.
So if there's a lot of uncertainty about how big the company gets and how successful it is, that matters a lot to the common shareholders, but it doesn't matter to the people lending the money. So it is sometimes surprising when some companies, companies like Boeing and Carnival and stuff, are able to raise such large amounts of money at fixed rates that don't involve conversion and stuff like that. Some of that was convertible and some of it was common stock with Carnival, but a ton of it wasn't. And, all you get back is your principal and your 12% a year.
If you were a Berkshire shareholder, what would you be thinking? Do you think feel comfortable, buy more, hold on? Because the perception. Somebody emailed me, or someone tweeted to me. She said, "I've been Dallas lady. At least that's what it says in her bio. That she's been holding Berkshire for 45 years."
Okay,
I'm like, wow, that's been a good win for you. And she said, "It's been great, but at some point, ... hinting towards when is it time to move on." And my response to her was, "You're still in good hands, and you may not get as filthy rich from holding Berkshire, but you're going to stay rich and you're going to continue to make money.
Yeah.
So what would your thoughts be?
Yes, I don't think Berkshire is exceptionally cheap now. I don't like Buffett said. I think that the value is not very different from when the fact that it's down, however much it's down, hasn't really made it more attractive because the intrinsic value has declined by a similar amount. But I don't think it's a great moment necessarily to buy Berkshire. But I do think that the only issue you really have is the size of their capital base. That is the thing that worries me about it. And it's the thing that is a long-term drag and they have to do something about. They can't continue to deploy as much money as they've been piling up. And so they have to figure out a way either to buy back a lot of stock or to pay a dividend or to do some more complicated way of distributing stuff. So I think that's the biggest drag that they have. But to be fair, if things got cheap, they could deploy a lot of it. It's just that the problem would creep back up again pretty fast. So like people talk about the successors or whatever.
Yeah.
I don't worry as much about that. I think that they'll have pretty good successors. It's just that no one can allocate the amount of free cash flow that they'll have coming in every year. I mean, he said under almost any circumstance, we're still going to generate cash this year, and that that cash flow is going to go up overall at Berkshire. So I think that it's a better time now than it's been at some past times versus the S&P. Not necessarily in absolute terms is that great, but on relative terms, I think their odds of beating the S&P are better now than they were in a lot of the recent periods. But in the long run, what I'd like them to figure out is there's just some amount of capital that's too much. And so how do we actually put a lot back? That probably will come after Buffett. That there'll be a decision about that to make it more manageable, Because like an insurance company or something has a certain ratio of premiums to statutory surplus or whatever, and that's what they aim for. And when they exceed that, they pay it out. A bank doesn't want to have their leverage ratio drop to 5 instead of 10 or something if that's what they're targeting. So there is some level at which you just have to say the holding the cash and stuff is fine. If it was $100 million in cash, if Berkshire was 1,000 times smaller, the balance sheet they have and stuff would be wonderful and they'd be easily able to deploy it. The problem is it's really hard to find deals that are 1,000 times bigger, I mean, when we talk about some of the distressed companies and stuff, right? So they could do a deal with Carnival, but they can't do a deal with Dave & Buster's.
Yeah. Dave & Buster's issued more stock today.
Yeah.
They did an at-the-market offering.
Yeah.
$100 million.
So, I mean, Berkshire didn't get super rich on things of this size generally, what they'll have to do. So they'll have to do things that are bigger. And just if you look at whether it's back tests of stock things or just what people know about it or whatever, it is very difficult to do as well in very big stocks and very big deals as it is with very small stocks and small sums of money. And he even said that. He said, the idea that someone's going to outperform with like billions of dollars, don't believe that. He said there's some people who can outperform with very small amounts of money, but then they'll get too much money coming in and then they won't outperform anymore, And in a sense, he's describing Berkshire, that risk, So I don't think there are any that he's lost anything in terms of skills. I just think that every time you increase tenfold or something, it gets a lot harder. So the only thing longer term is what you do about that, like buybacks and dividends, just in a way of getting rid of capital, bringing it down to a manageable level. That's the only thing that I think they really have to do. But my guess is that's not a decision they really have to make until after Buffett and Munger, unless if the stock gets very cheap, they will buy back huge amounts of time. Yeah, they would do that. But that's something like it would have to stay cheap for a few years. But if it stayed cheap for a few years, they could buy back huge amounts over 3 years or something if that happened. Like he laid out the Great Depression type thing.
Yeah.
If anything like that happened in terms of huge stock declines, and not just that, like it did in the 70s or like it did in other times, then I think that they would buy back a ton of stock and that would help fix the problem. But as you buy operating companies and stuff, you just produce so much free cash flow. So that's been my concern for a long time, is that just the size. And they're very clear about that. He's very clear that we cannot do possibly as well at this size. But, to some extent, it's a problem that a lot of the S&P 500 type companies have. It's just, they pay out more in dividends and stuff. So they got to figure out something about that.
Cool. Well, I want to thank everybody so much for tuning in with Geoff and myself on our homecoming episode. Back together filming this. We hope everyone has enjoyed the content lately. When we really thank everybody for bearing with us when we were streaming over the internet. If you're listening on YouTube, hit that subscribe button, thumbs this video up. And of course, if you're listening on the podcast side, a rating and review goes a very long way. I want to thank you so much for tuning in, and we will see you in the next podcast.